Electricity demand in the US is entering a structural growth phase, largely driven by the expansion of AI-powered data centers. According to a report by McKinsey Company, data center electricity consumption is projected to exceed 600 terawatt-hours annually by 2030, representing more than 11% of total US electricity demand. And this surge in demand is happening faster than supply can scale, particularly as traditional energy sources like coal are phased out and replaced with renewables. While renewable energy offers faster development timelines, the transition requires significant infrastructure investment. Since 2024, power generation from fossil fuels such as natural gas and coal have fallen and are projected to continue falling in the coming years. Production from renewable sources such as wind and solar are projected to rise and contribute to a higher portion of the electricity generation. From 2015 through 2024, utilities invested approximately $1.3 trillion in capital expenditures, with another $1.1 trillion projected through 2029. These costs are increasingly being passed through to businesses and consumers in the form of higher electricity rates. In fact, both residential and commercial electricity costs have risen steadily since 2021, reflecting this imbalance between demand growth and supply expansion. From a commercial credit standpoint, the electric energy sector presents a distinct profile. Credit-active businesses in the sector have grown faster than the broader market, and financing demand has accelerated, particularly over the past 2 years. The sector is also significantly more capital intensive. Average commercial balances per business are roughly 4 times higher than the cross-industry average, and financing structures skew toward leases and term loans rather than revolving credit. Now, at the same time, credit quality has improved. Severe delinquency rates, those over 90 days past due, have declined materially and now sit well below the broader market. And this combination of strong demand, high capital investment, and improving credit performance positions the energy sector as an increasingly important area of focus for lenders and risk professionals. So what does this mean for small businesses? Rising energy costs are likely to become a more persistent pressure on operating margins. As utilities continue to invest in infrastructure and pass through costs, businesses may need to adjust pricing strategies, manage expenses more tightly, and reassess capital planning. At the same time, the broader credit environment remains relatively stable, with continued access to financing supporting business formation and growth. For lenders, this environment underscores the importance of segment-level insights, particularly in capital-intensive industries where credit demand and risk profiles are evolving rapidly.